In the cert, it's got a cancellation of debt section in which, let's say they had a Discover card. And the thing that you have to watch out for too is they'll include interest and principal on these, so they can be quite high sometimes. And so let's say they had 10,000. Everybody here, have they dealt with cancellation of debt before in the past? Somewhat.
I have once.
Yes. And so we saw it a lot. If anybody in here was doing taxes 2007, 8, and 9, you saw a lot of it between the houses and the mortgage crisis and all of that. We'll touch on housing debt as well. First would be most that you see is unsecured debt, which boils down to credit cards, things of that nature. So what happens is if anybody pays less than the balance due on a debt that is out there, you'll get a 1099-C, and it reports canceled debt income, and which it is technically canceled debt, it's income. And so it gets reported as canceled income. I'm going to go ahead and do a screen share for Lacert to show you guys kind of the process of it, if you will, and writing it off. So here's the other thing too, is I net it off on the tax return and attach a note with an explanation along with form 982, the canceled debt form. The reason why I put the 1099 on and then net it back off is so that the IRS will see it on the return. I've read several things that says if they qualify for like insolvency or things like that, you don't have to report it on Schedule 1, but I'm not a big fan of that. I put it on there anyway so that it's documented. You got statute of limitations in effect then, and that way it's on there in writing. That's the same that goes to just another instance where they say you don't have to report it, but I always do is section 121 exclusion on the sale of a home, where it says if you qualify for it, you technically don't have to report it on Schedule D. And that's just a huge mistake, because 9 times out of 10 they put it on a 1099-S, you'll get a huge letter, things of that nature. So no matter what, I always report sales of homes that qualify for section 121 on Schedule D, and I always put 1099-C canceled debt on the tax return, but then I net it off with a negative and why. And so on to the very exciting screen share here. And we'll pull this over here. All right. That's showing up for everybody? So yes. In the cert, it's got a cancellation of debt section in which, let's say they had a Discover card. And the thing that you have to watch out for too is they'll include interest and principal on these, so they can be quite high sometimes. And so let's say they had $10,000 of canceled debt. Now what's going to happen is that's going to flow through. Got Pronto Pete here. That's going to flow through to Schedule 1, which it's got its own line. Line C on Schedule 1, or sorry, 8C, canceled debt. It shows up right there. And so what happens is let's say the main reasons why that it would not be considered income, main reason one would be is if it's disclosed in bankruptcy, it's not taxable if it's canceled in bankruptcy, but credit card companies love to still issue a 1099-C. Number 2 is because if they're insolvent, and we'll cover that. Insolvency means at the time the debt was discharged, that their liabilities exceeded their assets. So they have more liabilities than assets. So whatever they're underwater by is technically not taxable. So it may be the whole canceled debt's not taxable. It may be a portion of it. And then the third reason is they do love to report on 1099-C. Sometimes if it's, you've got two different kinds of debt. You've got recourse debt and non-recourse debt. So recourse debt means the taxpayer is personally responsible for it, despite whatever was backing it. So that's unsecured debt, which means they're personally liable for it, which means they can go after them for it. So the other is secured debt. And what that means is there's some type of asset that is covers the loan basically. So as long as they get that asset back, the loan is forgiven in full and it's not income. Instances where you will see that is on a vehicle. It's a secured debt, so that loan is secured by that vehicle. And as long as they get the vehicle back, it satisfies the debt, no matter what the fair market value of the vehicle is. Other times is with a home. It is secured by the home and therefore non-recourse debt. And big note on that, though, is that when you originally purchase a house, it is non-recourse debt. So the house secures the debt on the mortgage that they take out. And then therefore, if they get the house back, it satisfies the debt no matter what. It's non-recourse. Here's a huge thing. David probably knows this because he does loans. If you ever refinance, that loan goes from non-recourse to recourse. I've never seen an instance where that does not happen. And so it's huge if somebody has canceled debt from a mortgage that you find out if they ever refinanced, because if they ever refinanced, that debt went from non-recourse to a recourse loan, which means they're responsible for the difference of the fair market value of the house, or if they turn it in, fair market value of the house to the debt. The difference could be canceled debt income. Or if they sell the house and that doesn't satisfy the mortgage, that remaining bit would technically be recourse debt. And then if it is canceled, it would be income. Same also applies to HELOCs and seconds. Those are generally non-recourse debt. So this is an instance where you have to put a little bit of a lawyer hat on, if you will. Don't be a lawyer, don't give legal advice, but you do need to see the underlying note to determine if it is recourse or non-recourse debt. So your first thing first is you have a taxpayer come in with a 1099-C. You need to find out what the debt's from, determine if it's recourse or non-recourse debt. And so if it's non-recourse debt, truly, then that's an easy thing to take care of on the tax return. You're not going to, and that's the thing, is this is something you have to fix on the tax return. Getting a company to issue a corrected 1099-C, I have yet to have it happen. They just won't do it. It's a pain, and I've never had one corrected yet. So you're going to determine if it's recourse or non-recourse. If it's non-recourse, what you will do is, and this applies for all three. So let's say it's it's not income, because if it's income, it's easy. You just leave it on there, cancel debt, line 8C, flows over to income, good to go. If it is not income and you have to fix it, what I do is under other income, in which you'll probably see it pull up. So non-recourse debt, I put an explanation, and then I put whatever the amount that's not taxable, I put it in as a negative, and then that way it nets off right here, put on a statement there, and then generally I will put non-recourse debt be attached. And that way it nets off, it's not an income, but you still have record of the 1099 being reported. Now, if you're doing it because of insolvency, and what that means is your debt is more than your assets, see Form 982, negative 110. It's still going to be negative, but then you have to fill out the Form 982, which is the discharge of indebtedness form. Now, the reason why I didn't do it for the non-recourse one is you don't use 982 for non-recourse. Non-recourse debt is just not income. You're not using an exclusion. You're not using anything. It's just literally a 1099-C issued an error. It should not have been issued. You can include a note on the return that it was non-recourse. Let's see here. I think we have somebody popped in. There we go. Okay. I thought that might have been a question. Okay. So you can include a note attached to the return that says that, you know, it was due to non-recourse debt and it shouldn't have been income to begin with. Now, if they are insolvent, discharge of indebtedness to the extent insolvent, total amount of discharge indebtedness excluded from gross income, see below. You've got 10, 1, 2, 3. And also a note on this, I'm doing this on Schedule 1 because this is personal debt. Now, the same rules apply, but you do have to determine where the debt came from. So if it's from a business, if it's personal, it goes on Schedule 1. If it's from a business, sole proprietor, this information actually goes on Schedule C, in which taxable discharge of indebtedness from a business is actually subject to Social Security and Medicare, unless you qualify for one of the exemptions. And then number 3, if it's from a rental, it goes on Schedule E. So you got to follow through where the schedule to the proper form of where the debt is coming from. In this instance, we're just handling personal debt. And so if it's from a credit card, what this is here is if you exclude canceled debt from income under bankruptcy or insolvency, then these rules apply. And what happens is you have to reduce tax attributes. And there's ordering. I'm not going to get into it. It gets a little detailed. So depending on where it came from, you have to reduce clients' net operating losses, credit carryovers, minimum tax credits, also capital losses, or applied to reduce the basis of non-depreciable and depreciable property, other than above. So this would be like on credit card debt. If you bought, you know, $10,000 worth of stuff on the credit card, then the basis of all that stuff you bought on the credit card would basically now be 0. And so you would put that in there and that reduces it. So you net it out, Form 982 comes in, you're discharging the indebtedness under the extent insolvent. They're not claiming bankruptcy. And then that way it reduces non-depreciable and depreciable property, if not reduced on line 5. So basically, if they have none of these, this is just your average taxpayer. Your average taxpayer is probably not going to have any of these. And so, but if they have like capital loss carryovers, things like that, you do have to reduce them. Now, what's the best way to get this through and to have it on file? Because you may get a letter on this. So you want to make sure that all of your T's are crossed and I's are dotted. The best way to get that information for insolvency, I use, there's a lot of different worksheets out there and everything. I use tax tools. Okay, share screen. So within tax tools, there's a cancellation of debt worksheet. And you can list out your 1099s. And here's an important one too, is the date of cancellation is the date that you have to value the asset. So when you're trying to determine if your liabilities are more than your assets, what date do you pick? So you pick the day before the debt was discharged. Now, if there's multiple within the same year, I'll go with the earliest one because there's the most debt. So I try to include them all on one. I haven't had an issue yet with doing that. So what it is you have a Discover card, $10,000 debt. Let's say it was discharged in March last year. So what you have to do is if it was discharged on March 20th, you have to go to March 19th to get your value of everything. So this is where you have to give this form to your client. I make them fill it out. I put it all on them to save a bunch of time. If you request all these documents from the taxpayer and fill this form out on your own, it takes a lot of time. So you can either charge a ton for this and do all the work, or you can charge a ton and still make them do it. Either way, we charge about $150. That's what I charge to do insolvencies. So I give this to the taxpayer. I tell them, pick March 19th, pull all of your statements or go online and find out the balances of everything. So let's say they had, $3,000 in their checking account. One thing to watch out for, I have them go to Kelly Blue Book to pull the vehicles. This is one I'll do for them if they can't figure it out. You just need to find out what kind of cars they got, and you go to kellybluebook.com. I get values of the vehicles. Let's say they're worth $20,000, and then other assets. The thing here, you got to watch out for personal property. That's all their furniture, everything else. Depends on if they live in a house or an apartment, how much stuff. That's why I have them fill this out, because I don't want to be responsible for determining values of such. So normally they'll put in, like $5,000 there. One thing to watch out for on this is retirement plans. That can really blow it up. They might be in debt up to their eyeballs, but they have $1 million in their 401k. And so you have to be really careful and make sure that they account for all of their retirement accounts. So let's say they even got 50 grand in retirement funds. So their total assets are $78,000. So current debt, so they got to add up all of their credit cards on that date across the board. So let's say they got 60 grand in credit card debt. Let's say they also got the other big one too is education loans, and also if they've got loans against that 401k. I've had that save a client to where they had a big 401k balance, but they actually had pulled out sizable loan on it as well. So let's say if on everything they've got another 10 grand in student loan debt, and then let's say another $10,000 on a 401k loan.
Hey Darren, are you actually filling out that form?
Yeah. Are you seeing it?
All I see is about quick access.
Oh, okay. Yeah, hold on.
There we
Is
go.
it showing
Thank
up
you.
now?
Yes.
There we go.
thank
Sorry
you.
about that. There we go. So this is the actual insolvency form that we use. So it's basically set up like a basic balance sheet. Sorry about that, guys. So we put in, the 1099s that they receive on the top, date of cancellation. This is the date we're valuing all of the assets and all of the debts. So you take that date, filled it out, checking, personal property, 401k. They got a car worth about 20 grand. So I'd say they got 60 grand in credit card debt, 10,000 in education debt, and $10,000 in 401k loan. So that'd be 80. They got assets of 78. So amount of insolvency would only be 2 grand. So you only can claim insolvency on whatever you're higher on liabilities than assets. So if you're coming out close, then some of it may be taxable. So you have to be careful. So you would exclude 2,000 from income. So that's where you kind of go back in and be like, well, if the automobile is 20, and this is why I charge for the form too, is because we got to review this. And, if they did the Kelly Blue Book, and let's say they picked the car was in excellent condition, but it really isn't, you go back in and fill it back out and say, it's in poor condition. And this comes out to 12,000 as far as what it's worth. Then total liabilities is 80, assets are 70, then you can exclude 10. So as long as you got some kind of backup for it, Kelly Blue Book, something like that. So some of these values are somewhat subjective. So that's where we got to, look out for our taxpayers' best interests. And make sure that you cover all the bases with them as far as what is actual debt. So credit card debt, notes payable, they might have loans to family members. They might have back taxes, that factors in as well. Student loans, even if they're in deferment, that still counts. So they may miss those, and definitely pick up any loans against 401ks. So let's say the loan against the 401k was 30,000. So then what you would know is amount of insolvency is they could have had up to 30 grand in canceled debt and not pay tax on it. So this comes in handy when as well, if you have somebody calling over the summertime or during the off season that says I'm negotiating with my credit cards, get it from them then. So if somebody calls in and says like I'm negotiating down my debt, something to that extent, I'll charge my client $100 or $200 if they want to get this done ahead of time, because it makes it way easier if they're doing it real time rather than going back to find everything. If they want you to do a calculation, say, hey, I'm looking at having this amount of canceled debt, will it be taxable or not? Make sure that you charge to put this information together and see if they qualify for insolvency. But then that way you can also, prepare everything and get real-time values before it actually gets canceled. Now, the reason, and I also send this in, so two things. I do print this out to a PDF. If I'm filing it on the current year filing, I do attach it as a PDF to the e-file. That way it goes in with it. Number two, the thing that you'll deal with a lot of the time on these is CP 2000 notices, because the 1099-C was probably sent to an incorrect address. And so the way I respond to those CP 2000 notices is I create a form 1040 schedule 1, net it off, put copy, and just say put, for example, on top of the 1040, include a 982. And then I also include a copy of this insolvency worksheet with the CP 2000 notice, and I've never had an issue with those getting reversed. I have to write a letter today. I had a client get a bill for about $7 grand from canceled debt that he had discharged in bankruptcy. And so we are going to fill that out as well. So covered that and that. Let me go back to Lacert real quick. There we go. So in your questionnaire and getting your answers from your client, if it was discharged in bankruptcy and they're not liable for it, you just change that to indebtedness. Title 11 case. Title 11 case is bankruptcy. So it doesn't come out and say bankruptcy, but that's what Title 11 case is. All of these still apply the same as for insolvency and everything else. So we're good there. The other big one is as far as if it's not credit card debt, 9 times out of 10, you'll see credit card debt. Every now and again now, we're still seeing principal residents come in. I still try to qualify them under insolvency. The reason being is California does not conform to the federal rules of home loan forgiveness. So Lacert gives a place itself here. If it's qualified principal residence exclusion on debt, then it covers itself on the form, which you got to be careful about because it does net it out. Oh, not there. So what happens is if you use it, it just nets it out and doesn't put it on the form. So you got to be very careful on your software and what it's doing. So rather than that and using what's in the software, I go back and do principal residence exclusion. And that's if it's purchased debt on the main home, following some other restrictions, you can get out of home loan. So this would be where if they got their house foreclosed on or did a mortgage reconsideration where they got their principal balance lowered. And then on the 982 discharge qualified principal residence indebtedness. Now on this one, if they sold the home, whatever the canceled debt is, you got to reduce the basis of your principal residence. So if they sold it, you got to make sure that's accounted for. And so, but see, this way it shows up canceled debt. That way it checks off the 1099. Way doing it this way, you're way less likely to get a letter. If you don't fill out the Schedule 1 on a 1099-C, you're probably going to get a letter, even if they do qualify, and then you'll just have to explain it at that point in time. But we do include it. And that one there, reduce there. You have to fill this out regardless if they sold it or not. Also make a permanent note on your taxpayer's file, because they might sell this home 20 years from now. But if it was like a loan modification and they got a big reduction in principal, then you got to make sure that's accounted for, because if they sell their home later in the future, you got to watch out for that.